Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 2, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Today we're going to do something a little bit different in terms of what I normally do. And what I mean by that is I don't normally give my opinions. Once in a while I do, and today I'm going to give you an opinion about what I think is coming in the S&P in the short term. We'll get to that in a minute. Let's talk technicals first, and then I'll tell you what I'm going to tell you. So as we look at the daily chart, I see two things, okay? Number one, I see a bearish pattern in the short run, right? So we have this little down move here. We're going sideways inside this high, which was the all-time high. And that'll generally promote another down move. And we've been talking about that down move coming back to the 245.40, the 20 moving average. In that neighborhood, that would technically complete that down move. Not to say it has to be over. It just, from a technical perspective, from a market symmetry perspective, that would complete, as far as I'm concerned, the move from the high. That was one dip down, then the bearish pattern, then we'd have another dip down. And that would basically be it. But from a technical perspective, there's two things going on in the chart that I see. What I just said, which is number one, and number two, if you go from a longer term perspective, right, you have an up move, and then we're basically just going sideways, and this is generally building energy for another up move. So when I look at the S&P chart, and this isn't like new information, right? I know I didn't just notice this, a half an hour ago. I had my eye on this for a couple of days, and while from a short-term perspective, it's somewhat bearish. And by the way, and I can say that from the hourly chart that we've been looking at for the last several days, and look at this. So this is still bearish, no two ways about it. This is a bearish pattern that will generally play out to the downside. So from a technical perspective, all signals point to lower prices. So if I'm just looking at the market saying, what's the market telling me? It's always talking to us. The question is, can we figure out what it's trying to say? Sometimes we can, and sometimes we can't. And right now, what it's trying to say is lower prices, right? But there's something else brewing under the covers. So let me go back to the daily chart, and I want to run through a couple of other charts real quick. So we got the picture there. From a daily chart perspective, we really have conflicting data. From a short-term perspective, we should have another move down. It looked like it was starting today, and they saved the market, and we basically finished flat on the day. And that is part of what I'm going to tell you in a few minutes on what I think is going on. Before we do that, let's go quickly over to the IWM. And the IWM got hit pretty hard today. So the IWM, unlike the spiders, really didn't recover today. It was down and it stayed down, and it was down 1%. Not on great volume, only about 20 million shares, so it's still less than the average volume. And on a down day, you would expect a little bit of a pickup in volume, and that may or may not play into what I'm going to tell you also. And I don't mean to keep teasing you like this. I just need to build up to something. I had this mapped out in my mind, how I wanted to present the information. So I'm not teasing you. It's not intentional. So one thing on the IWM that I find important and interesting is from the high, the pivot high, which is this day right here, and the high is 144.25. The next day, the high was lower. So this is the high. And if I'm going to begin counting the days that we were down from the high, I begin at the high on that day. So if we take a look at that day being number 1, 2, 3, 4, 5, 6, 7. Today was the 7th day down. As you know, to me, that's a very important number, okay? I like 7s, I like 10s. Those are very important numbers in my world, in my work. And being down from the high or from the peak, this is the 7th day. This could be, at least in the short term, right? Everything I'm telling you is short term. And when I say short term, it's for the next week, the next few days. I'm not talking about months. I'm just talking about in the short run. So in the short run, this could be an ending move, okay? We could see a bounce come, for example, tomorrow. Now, this could be what I'll call it is a fake out, right? The IWM is down. In my work, it's the leading indicator, the best leading indicator that I've had in a long time, right? It's always my favorite leading indication of the market. And today, it's leading on the downside, and it's telling me, from a technical perspective, it's telling me lower prices are coming, and that may be the case. That's what the IWM is telling me, and that's what the spider is telling me from the short-term perspective. Lower prices are coming, okay? Now, one more thing. Let's go over to the transports. Transports today came in, they touched the 200-period moving average, and they bounced off of it, and they finished near the highs of the day. That's interesting. Let's take a look at an intraday chart. Well, first we'll look at an hourly chart, and we'll see here. Doesn't look like much. Still looks like a bearish pattern from a technical perspective. We have down move, we have sideways, and generally this will have another down move. But if you put your glasses on and look a little bit closer, what you'll see here is an up green candle. We're consolidating around the 20-period moving average, and we're starting to break up at the close of the day. That's interesting. We'll see what happens. Let's go to a 10-minute chart, and we'll get a little bit of a finer take. So a 10-minute, we saw the market bottom out this morning, and we're basically an up move, and we consolidated. It's the same chart, obviously. It's the same consolidation. We're just looking at it from a 10-minute perspective, and we seem to be breaking up, heading toward at least the 200-period moving average on the 10-minute chart. But that's what we see. So from a short-term perspective, meaning hours and minutes, it's a bullish-looking chart, at least from the transportation average perspective. Now, while we're taking a trip around the world, let's look at the Qs. Sometimes we look at the NQ, which is the futures, the NASDAQ futures. Today we'll look at the NQ. It's the same chart. It really doesn't matter. Looks almost like a mirror image of the spiders right now. From a short-term perspective, it does look bearish, but remember this down move, sideways consolidation. We got another down move. The market symmetry, in my mind, worked out. You have the down move, the sideways, and then an equidistant down move or an equal down move to the first one. So the market symmetry worked out, and now we've rallied back and we closed above the red candle high. You can see that here. So we've gotten above and closed above that red candle high, and that's important. Now, we've gone back below it, but once you close above it, that bearish pattern is off the table. So this is no longer a bearish pattern. We have a short-term bearish pattern, but longer term, the fact that we closed above that red bar high, that red candle high, that's important. I think it's important information. It basically takes the bearish pattern off the table from a longer term perspective. And if I switch over to a weekly chart, you'll see here that really, there's a doji candle from last week, but essentially there's nothing wrong with this market. This market is in an uptrend. It's bullish above all the moving averages. From a weekly chart perspective, there's absolutely nothing wrong with this market whatsoever. Not bearish at all, okay? So let me go over to the spider for a second, or back to the spider. So we talked about the daily chart. We haven't looked at the weekly on the spider yet. And I know I'm jumping around, but you can obviously rewind the video. You can look at it as many times as you want, but most of you are following along. I know that. From a weekly chart perspective, same as the Qs. There's nothing wrong with this chart. From a weekly chart, this is in an uptrend. And you know what I say and what everybody else says. I didn't make this up. The trend is your friend until the very end. That's just the way it works. And right now, from a longer term perspective, the trend is still higher. And that leads me to what I really wanted to discuss. Now, this is an opinion. So I gave you all the technicals, and there are more technicals and more information that points to the downside in the short term, at least, than points to the upside. We've established that, okay? However, there are some things from a short-term perspective, namely the transports and a couple of other things that certainly point to the upside. And there's another thing that's on my mind all day long, which is this morning they had another opportunity to sell the market off. Let me go back to a 10-minute chart here just for a second, all right? So you see this sell. That's a pretty decent sell first thing in the morning. They had every opportunity to drop the market lower if they wanted to, and they saved it. And when I say they, it doesn't really matter who it is. Just it's a general comment. They. Whether you believe in the plunge protection team or it's the buy the dip crowd, more likely it's the buy the dip crowd. And therefore, every opportunity the buy the dip crowd has to buy the market on an intraday dip, they do that. Okay, so any way you want to look at it, it doesn't matter what the reason is. What matters is where the market is. And where the market is basically flat from where we're at the lows of the day, or flat from where we closed yesterday, but we had every opportunity to sell the market today. They had every opportunity. And it just didn't happen. And that has me a little bit suspicious, to say the least. And now that brings me to what else is going on this week. We have a phony jobs number this week. So that has a tendency, more often than not, to be a spark to the market, more so to the upside than anything else. It becomes the excuse for upside to the market. Now, remember I had been discussing the S&P E-mini futures contract, and right now, and I'll just bring it up real quick, here's the continuous contract. We're at 24.73 and change, 24.74, in that neighborhood, okay? So you see what's going on here, and there's about 25 points, give or take, to the upside to reach a big fat round number of 2,500. I think that's more important than meets the eye. I think they're going to do it. I think they want the futures to get up to the big fat round number of 2,500. Who that is, why that is, it makes no difference. I think it's going to happen, and that's what I wanted to discuss. That's my opinion. Okay, it's not from a technical perspective. What I'm telling you is that as many things as I can see that line up on the downside, namely the IWM being the sole leader on the downside today, which is an anomaly in and of itself. Nothing else was down. NASDAQ Composite was down a fraction, but I'll call that flat. But the IWM was down 1% today, but it was the Lone Ranger. So I smell a rat. And that's what I'm saying. And if the market's having a difficult time getting through some of these levels, we'll go back to the spider for a second. Okay, let's go back to the daily chart. All right. And if it's having a difficult time, there's in a bearish pattern, and we had a pretty decent down move off the high from the 27th of July. And what's likely to happen if they're going to get through there, generally speaking, they need to consolidate to get through there. Or the other option is they can gap above it. And that's a possibility. Tomorrow, Friday, anything goes. I'm giving you my opinion. I smell a rat. I'm giving you the technicals point to the downside in the short term, but my opinion is I smell a rat. And that's what I wanted to bring to the forefront today. Now, in the big scheme of things, it's not all that much. I mean, 25 S&P handles is 2.5 S&P points, or 2.5 spider points. It's not that big of a deal. They can do it in 1 day. They can do it in 2 days. Any way you look at it, it's not that big of a deal to the round number. But I wanted to bring it to everybody's attention, and I thought it was interesting. We'll see what happens. If we don't gap higher and we don't, have a gap and go, as it's called, and gap above an important level, and we do play out to the downside, then the technicals will have prevailed. I'm just giving you what my feeling is. I'm giving you what my opinion is. I'm not giving you what my technical analysis is. I've already given you that. My technical analysis says the market should be going lower, but I have a funny feeling, and I just wanted to let everybody know. That's it. Looking over at the gold market, basically what we've done so far is we've come up, I believe, just shy of the 7.5 retrace from pivot high to pivot low. And now we're pulling back a little bit, but I'm not really sure this is anything meaningful. Pivot high, pivot low, 7.5 retrace was right up here, and we basically kind of kissed it. We didn't quite get there as far as I can tell. I just did a quick and dirty, and if you just want to bear with me a second, I'll do it again. If you take a look at this, I'm not necessarily on the penny, but I've got to be close. So it looks like we came up just short. The high was 1280 spot 30. The 7.5 looks like it comes in just around 1281 and change. So therefore, we came up a little bit short. Now we're pausing a little bit, but my take is that there's probably not a lot of downside coming in the gold market right now. Maybe we consolidate for a while and push higher. Looking for a triple top, a double top, whatever you want to call it. I'm looking for 1,300. I would love to see gold get up to 1,300. I think it's a stone cold short up there, so I'm kind of hoping it gets there. Right here, we're in the middle of a range, more or less, and there's nothing that tells me one way or the other it's going in one direction or the other. So we're in no man's land as far as I'm concerned. So there's no trade available in the gold market, at least not a high probability trade. So we'll move it along and we'll look over at the silver chart. Silver was down a little bit more today than gold was. Gold was down about 0.5%. Silver was down a little more than 1%. And you can see here, that's a spike higher and a reversal. So to me, it looks like, at least from a technical perspective, it looks like silver wants to go lower. It looks like it wants to get into the 20-period moving average, and that would give it about a 382 retrace, maybe slightly, maybe the 382 comes in slightly above the 20-period, and the 50% retrace is slightly below it. So anywhere in this neighborhood is where I could see silver going, but we need a little bit more follow through. So any close below today's low, and that's a fait accompli in my book. But other than that, we could still go sideways and trade higher. Again, we're in no man's land. There's no high probability trade. That already happened at the retracement level. And when I say retracement level, there's two that come into play, and it's very interesting. Watch this. So here you have a pivot high and a pivot low, okay? And your retracement that we hit a couple of times over the last couple of sessions was the 618 retracement, okay? That's one thing. But if you clear that out and you look at a different pivot high, all right, up here, all right, and the same pivot low, pardon me, same pivot low, what we did today was we spiked through the 50% retracement, which comes in right here, which we did not hit the other day. We did not hit it yesterday, but today, it's a little higher than my line is. We hit it today, and that's where the market reversed. So it's interesting. I mean, that's fascinating. I didn't trade that. I don't know who could trade that, but we talked about a couple of times that the markets will respect, in a case like this, more than one retracement level, and that's pretty much what happened. When we hit the first retracement, we backed off. And then today we spiked up in the morning, and we actually hit the second retracement. And just for kicks, hold on a second. Just for kicks, I'm going to draw it on. So here's the pivot high I'm talking about, and here's the pivot low. And actually, I put the numbers on exact just now, and we actually came up a fraction short. The high, I'll move this over, and watch this. The high today was 16.96, 16.96. And the retracement, the 50% retracement, is 16.966. Pretty remarkable how this works. Fascinates me just about each and every day. And I know it fascinates some of you just the same. That's why you're here, because this is unbelievably fascinating when you look at the fact that the silver market respected two different retracements levels in the span of 3 days, and one of them required a spike higher, and we're not going to split hairs over half of a fraction of a penny. I mean, it's ridiculous. So in the end, my take is we'll probably get more of a decline in silver, but again, we're in no man's land. There's no high probability setup here. If we pull back into the 20-period moving average, depending on what we do over there, maybe we put in a reversal. Maybe we're going to find ourselves in the midst of another ABC corrective pattern. We're familiar with those. You have an A, we have a B potentially developing, and then you'll have a C finishing move in the upside. This is a zigzag pattern, an ABC corrective pattern. That's a standard garden variety chart pattern. When we look over at crude oil, yesterday we saw a pretty decent reversal, and we went all the way from 50 and a half, or what was the high, 50.43, all the way down to 48.37. That's a pretty wide-ranging day. As you can see, a lot of the days, not all the days obviously, but a lot of the days have about $1 swing in them, give or take. And yesterday was a pretty wide-ranging day, and that generally is a signal of more downside coming. However, today we're up again, and we're up about 1%, slightly less than that. So we'll find out whether this is a retracement of yesterday's move and we have more downside coming, or was yesterday a fake out and we're going to make a run for the 200-period moving average. Not 100% sure which one it is. I would favor the downside, but if I'm right in the stock market discussion about my opinion, not the technicals, but my opinion, then I would find it hard to believe that we're going to get, and not that the markets have to trade together, you know I don't believe in that, but I would find it hard to believe we would get a hard sell in crude while we're getting a lift upward in the stock market. So that's that's kind of hanging out there in my mind. And then even though you look at the 60-minute chart, what we're doing here is we're beginning to put in some sideways consolidation above the 50-period moving average. So that's certainly not bearish, but in order for this to get any kind of momentum to the upside, we would need to close above, hourly close above 49.70. Until and unless we can close at least one, if not obviously more, hourly above 49.70, then there's nothing doing on the upside. If we close above 49.70 on the upside, then I think that there's more upside coming in crude oil. That's my take from what I can see in the chart or on the chart. Looking over at the bond market, remember what we were saying, they like to challenge the red candle high in this case, right? This was a down move, bearish consolidation, became a bearish wedge pattern, and what they did, the high was 154.11. Today's high spiked above that, making a high of 154.18 and backing off. Okay, so they like to challenge the red candle highs, but we certainly backed off, did not close above that red candle high just yet. We'll see what happens later on, but if they do, then there could be more upside in the bond market. If that was all they can do on the upside, and it may very well be, then we'll see a resuming down move in the bond market. Today was day number 7 from the down move. This red candle, the down move, today was the 7th day, including that day. So we're at a very critical and important juncture in the markets right here, right now. And I think it's not just the bond market. When I say that, I think it's a critical juncture across all the markets. I feel like there's something else brewing that's more than meets the eye. And that's what that's what I've been trying to get the point across. And I'm sure I did. We'll see. We'll know soon enough over the next day or two. We'll know soon enough whether the technicals were right or my gut was right. Let's go over to the dollar. And the dollar, you can make a case for it's trying to put in a bottom. We'll see. When I look at the weekly chart, all right, so you can see we spiked the 200-period moving average. That's what we want to see. We want to see a spike of the 200-period moving average. We got that. I think the close by Friday afternoon is going to be very, very important for the dollar. So I'm going to reserve any further commentary for the dollar, and I'm just going to say that this week's close is going to be extremely important for the dollar. But I don't want to forget to say long and wrong the dollar. I have to say that. It's a requirement. All right, that's basically everything that I wanted to discuss tonight. Hopefully I didn't confuse anybody, but I always want to give you everything I've got. That's my goal. I've got to tell you everything that I'm seeing, and today it was from a technical perspective and from an opinion/gut feeling perspective, and we'll leave it at that. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.